really appreciate you all joining us today. For those who don't know me, my name is Chris Lustrino. I'm the founder and CEO of Kingscrowd. We are really focused on empowering investors to have best-in-class education and research tools to make thoughtful investment decisions in the alternative investing markets, right? And we really focus on doing deep dives and analysis on operating companies that you can invest in via Reg CF and Reg A. But today we have a really unique opportunity of having on the founder and CEO of FranShares, Kenny Rose. Kenny is a super, super interesting guy and someone that I have known for many years now that has been building FranShares for many years, which has been, I'd say, a labor of love and certainly not an easy path. And they've come a very, very long way. And I have the utmost respect for what they're building. So Kenny's going to hop on here in a second, but I just kind of want to give you a little bit of an overview of the organization. For those that are on the call, I'm sure you've heard of franchises, right? And most notably, you probably know franchises in the context of brands like Dunkin' Donuts, Pizza Hut, McDonald's, and so on. And franchises are a really powerful way to invest because, as franchisors will tell you, it's a business in a box, right? And what do I mean by that? Well, when you're building a brand new company, right, and you're trying to find product market fit, you don't know if people actually want your service. You don't know what the economics will look like. There's so many unknowns in just starting up a brand new business. But when you start up a Dunkin' or a McDonald's or a Pizza Hut, you pretty much know exactly what all the economics are going to look like, how much the products are going to be priced at, how much volume you'll do each year. There's a lot of metrics that they have basically out of the box before you even purchase a franchise to help you navigate making your investment decision. So I'm going to ask Kenny to come on up here, and he's going to be the one that gets you into the details of all of this. But the reality is historically, investing in franchises has required you to be an operator that's often investing upwards of $1 million to open one location. And Kenny and his team are creating a way to, with $5,000, have access to a portfolio of Dunkin' franchises or of Pizza Hut franchises or whatever it may be, which I think is very, very powerful and is a really unique and lower risk way. And again, that's my opinion. That's not financial advice, but lower risk way of investing in the private markets beyond investing in businesses where the concepts aren't proven yet. So really excited to get into this conversation. I think it's going to be a ton of fun. And I hope you end up deciding to check out FranShares because honestly, every time I go on the site, I find myself wanting to just like dive in and check out all the deals. I've always been into franchises. I think it's a super fascinating space and it's something I've always been interested in. But I just think it's a really fun conversation. So Kenny, thank you for being here.
Thanks for having me, Chris. Super excited. And we don't have the chat set up for audience to submit, do we?
Great question. So actually the audience can submit questions both in our Q&A section as well as on the chat. We prefer if you go into the Q&A because then we just have the list of questions throughout.
Well, actually, I was going to ask them to submit something.
Oh, please.
I was curious while we're getting introductions going, if you guys could actually send out what franchise you're familiar with, like name a brand that's a franchise that you're aware of. Always love getting answers to this because they are all over the place. But yeah, what's an example of a franchise that you're familiar with?
I love that.
And
That's a great question.
it's always different and also always the same, I come to find. So while we're getting some of those coming up, love to give you guys my background and also, um, talk about franchise and the franchise industry as a whole. Um, so let's see, is anyone coming there?
Costa
Costa
Vida?
Costa Vida. All
I
right.
honestly haven't heard of that one.
It's been I'm not sure I'm familiar with it either. I there it was in Chicago. I'm not sure if it still is. Um, Jollibee, that's a
Jollibee.
good
Yeah,
one.
that
Subway,
is a good one.
keep these coming, guys. They honestly give me like nostalgia as well as just great things. Higher Quest, Pet Evolution. George, I appreciate you because you actually did something that other people didn't. Usually, when I ask, can you name some franchises, I always get food. Frankly, food is the number one industry people think of as synonymous with franchising. And, I'll tell you why that is. It's really because franchising is a way of doing business that helps you fill in the gaps of what it takes to be successful. And when you're in the food industry, you're in the most competitive industry known to man. So you need marketing. And so that's why you see McDonald's commercials everywhere, but you may not see Pet Evolution commercials everywhere. Franchising is as big as fast as food is within it. That's just one industry out of hundreds that franchising covers. It's things like pet care. It's things like business services like HireQuest. It's things like automotive, fitness, hair care, um, massages. Like you think of just about any industry, there are franchises for it. And I found this out in a very different career path that I took. I'd started off in the world of finance at Merrill Lynch and realized the big wirehouse wasn't something I wanted to do for the rest of my life. And someone asked me what I knew about franchises. And this is about 15 years ago now. And I was like, McDonald's, Subway. Honestly, I didn't know about Jollibee at the time. I think they were still across the world at that point. And he said, "Did you know my company's a franchise?" Now, mind you, his company was executive coaching. And I was like, that is a franchise? And I learned that they franchise everything. If you think of the type of industry, there's a franchise for it. You just might not know it's franchise because fast signs is like the world's largest maker of signage. And
Hmm.
you'd say like, ah, that's a weird one to go with. But you think about it, there's signs for not just in front of stores, on top of stores, inside stores, on the streets, even in hospitals, all those little nameplates for each hospital room or even hotels, those are made by a franchise generally. And so franchising covers hundreds of different industries, and there are more brands out there than there are stocks on the NASDAQ. That's over 4,000 different franchises. So that's to say two things. One is that franchising is bigger than you thought. And two, uh, just because there's that many, just like there's that many stocks on the NASDAQ, doesn't mean that they're all good. So, what we're trying to go over today is how do you actually invest and invest smartly? Um, and with that, I actually have a little presentation for you guys here. I wanted to pull up. Give me one sec.
Yeah, no problem. Now, I love that. And I see Speedy Muffler came up in the chat. That's one of it's kind of funny. This might sound dumb, but for a long time, I thought only small box stores and retailers would fit a franchise model. But like Pet Supply Plus, right? Which it looks like a Petco, like that's a franchise. Like it could be large store formats too. It is fascinating how wide, the reach of franchising is.
Yep, and speaking of which, so I'll continue that. I learned all this about the franchise industry, and I got into the space as what's called a franchise broker, or you oftentimes hear them called franchise consultants. And basically, it's you'd work with individuals who were exploring franchise ownership, but didn't know all this stuff about franchising and wanted to learn more. And so you'd recommend brands for them based on their budget, their skill set, and their goals, and recommend brands for them and help them with the research and purchase process. So it's kind of like being a realtor, but for the world of franchising. So I did that for about a decade. And what I realized over time is that everyone who's got the money for a franchise generally doesn't want to run the franchise. They want someone else to do it for them, or they want it on the side. Really, they want the benefits of ownership without running the business. And then you've also got lots of people who have all the experience but lack the net worth and liquidity in order to become a franchisee. Um, so, what we're going to talk about today is the franchise industry as a whole, why you'd want to invest in franchises at all, then introduce you to FranShares and what we do, and talk about crowdfunding with it. So this industry, as I mentioned, covers thousands of different brands, and it does almost $1 trillion in the US. So it's about 3% of the US GDP. So I talked about all these different industries. It goes on and on. Even clothing recycling, the parking lot striping. Like I'm not joking. If you can think of it, there is a franchise for it. And it's also one of the biggest employers in the US because there's almost a million locations and they employ almost 9 million people. So we have a big industry. What do we do with that? Well, we got to talk about the problem with it. And this is what I was mentioning is that the really experienced people, you think of like a district manager for a Dunkin' that's run 20 locations underneath the owner for 10 years. Man, that person would make an incredible franchisee. But they worked under a franchisee. They don't have the capital there available to them. It doesn't matter how much experience you have. They look at you like you're buying a home. And then on the other side, hey, I've got cash. I'd like to invest in a franchise, but you either don't have enough cash because they require healthy six figures, sometimes seven figures of liquidity, but also they require time and expertise. You have to be a small business owner. You have to work with people in a small business. You have to really leave the corporate world that most people are familiar with and do an entirely new way of actually really doing their day-to-day life. But yeah, so that's really the big problem here. And that problem is, I want to invest in it, but you'd say, why do you want to invest in it? Well, for one is the passive income. The paycheck does not go the same way as far as it used to. And when you also look at retirement age, it's Social Security is not going to keep you going. I mean, honestly, I could go on and on for all the different reasons of why you'd be looking at passive income, and probably most of the reason people are on here. So franchises generate that as a cash flowing small business. And additionally, because they're a small business, they have equity appreciation. Over time, as the business has started and grows, the value of that business goes up. Next, and what's very differentiated about franchising is the diversification. Especially in recessionary times, you're looking at like, hey, what's going to do good in a downward economy? Well, Apple stock can go down, but people are still going to get their haircut. They're still going to eat. They're still going to work out. They're still not buying new cars. They're going to make sure those old cars are running longer. And so all of these are different industries that franchising covers, and also insulates you from what the market is doing. We could be terrified about what's going on in the economy and Fed rates, but the fact is that people are still doing these everyday essential services. Um, Next is the inflation side of things. I know, especially the last few years, that's been a massive problem for people because as value of a dollar is going up or down, you're looking at, well, my stocks are going to be impacted by that. And honestly, that's a big part of that is that you haven't actually covered the inflation part by owning the stock. You are trading on dollars that are operated off those inflationary dollars that happened a quarter or two ago. But if you're investing in a franchise, they are raising those prices as inflation happens because they have to. And as an owner, you're getting the benefit of that. They are correcting themselves on the front lines. And so your investment is seeing that protection there. And then finally, franchising has a lot of protections with regulations in there. For one, the Federal Trade Commission actually is the governing body over franchising. And every franchise has to produce what's called a franchise disclosure document. Uh, this document is everything you could think of about the franchise, from who the leadership team is to has there been litigation against the franchise? How much does it cost to get a location going? You could start Googling franchise and start getting ads. Hey, buy a franchise for 50 grand. But what they don't tell you is that's just the franchise fee. And then if it's a physical location, there's build out costs, there's staffing costs, there's grand opening costs. And so all that has to be outlined in these disclosure documents. And they also give you big clues into what your investment's going to look like. So they can actually show you, hey, based on our average location, they produce X amount of revenue and Y amount of profit every year. And so you get a lot of transparency that you don't find in things like real estate and other types of entities out there. And then, in addition, where you work with FranShares, there then comes in the SEC regulations. So you've really got two different government bodies that are overseeing everything. Chris, any questions or anything I'm missing? I know I'm going a little fast there.
No, no, I appreciate it. And I think you'll get into it. I'll be curious to hear how these deals are structured as a passive investor, because you mentioned things like distributions. Like, is this an equity offering? Is this a debt offering? Is this a mix thereof? So I'll just be curious to learn more about kind of the structures of these deals as well.
Oh yeah, coming right at you. Um, and before it gets into the structure, it's really in like what are you actually investing in? Before how we structure it. So, what FranShares does, we are the platform that connects investors to franchises to invest in. So think of it like the stock market, or if you're familiar with crowdfunding, like the Fundrise, but for franchising. We're here to connect you to those opportunities to invest in that have been vetted and allow you to earn passive income and the equity appreciation, all the benefits of investing in franchises. So how do we select these? I always say it's brand, operator, opportunities. So first, you are identifying these franchise brands. They could be household names or they could be smaller up and coming brands. And you're going through the different, those FDDs that I was talking about. You're looking at what same store sales growth is like, how locations are growing over time. Um, all the different ways that you want to make sure that it's a profitable brand, a good brand, a protected brand, and one that you can be sure is the top down that they're being good stewards of capital. Again, they're not the actual operators of the locations you're investing in, but they are the ones that provide all the support and the foundation for that franchise to run smoothly. Once we've identified the great brands within there, you could have the McDonald's of the world, but if you have someone who's coming from Wall Street who's never worked in a kitchen in their life, they're going to run that right into the ground. And so it's really about making sure you have the best operators who are going to be good at working with people, who are going to be good about knowing the market, expanding the operations. So we look for experienced operators that have been with the brand or similar brand and have a decorated track record of running these locations. So, some good examples from FranShares. When we first launched, we had a husband-wife team. They were store launchers for Buffalo Wild Wings, and between the two of them, launched 150 locations.
Wow.
And then wanted to become their own franchisees, but they were working for Buffalo Wild Wings corporate. They didn't have $1 million laying around, but they had all the experience on how to launch and grow successful locations. So we connected them with our investor base. And, I always like to say under promise, over deliver. And based on those franchise disclosure documents, we said, hey, here's what the costs are, here's what the average location makes. It's going to take 4 years to get there. And because they are really hands-on, experienced operators, they actually beat it in the first year and have beat it and grown every year since. And so it really goes to show you the power of like, hey, and that was with the brand called Teriyaki Madness, which smaller up and coming brand, 300 or 400 locations, which puts them actually in the top 15% of brands based on size. But yeah, it's even with the smaller brand, when you've got those great operators, they're going to deliver results for you. But the opposite can happen too, is you could have bad operators who are with the right brands and uh, not good stewards of capital is the nice way of putting it. But then, even today we're working with some of the largest franchisees in not I was gonna say the country, but the world. Um, but then after you've identified these brands, the operators who are running them, due diligence time. Uh, going back and understanding their experience both as a brand and as the operator, but what the fundamentals of the deal structure are. So, that goes into your question, Chris. We are typically doing equity investments. Uh, you know, uh, it's important to really have the upside when you're investing in a small business. And I think just doing debt doesn't really offer the upside that investors do for taking financial risk at that level. Um, yeah, but the criteria, return ROI, availability. So we're looking at like what regions are available. We want to find good markets. Um, Manageability. So does the person need to be in there every day, or can they hire management to work alongside them to help them grow this into multiple locations? Um, we look at the leadership, not just of the franchisor, but that franchisee as well. Franchisor, again, is actually the parent company that is supporting all the locations that are in your backyard, which are franchisees. Sustainability. So like, uh, we want to make sure that they are, they're not just like a fad, something that's hot right now. Like I love every year I get asked about new fads, and it's like, hey, I see that this industry is the hottest one right now. Would you get into it? I think now the big one I hear a lot about is the cookies. But I remember when it was frozen yogurt, and I say stay away from desserts. But so you want to make sure that it's something that's going to be able to sustain ups and downs of what the fads are. Um, then competition and competitive advantages. So, uh, honestly, people love to ask about industries that don't have competition. And honestly, those are the worst industries to be in. There's usually a reason there's no competition, is that there's no money to be had in it. Franchising is not about creating new industries. It's about consolidating industries and finding the best practices and putting them into one brand. And then also, what does that brand do better than the other competitors out there? Um, Growth. So that could be both like same store sales growth, number of locations over time. You want to see that the brand is growing and the franchisees are growing underneath it. And then recession and new addition in the last 5 years, pandemic resistance. So, if the economy starts going down, how is my franchise going to perform? If the doors get shut on everywhere again because we've got a pandemic, how does that affect this business?
That makes a lot of sense. So, just a couple things, if you don't mind, that I'd love to
Yeah.
understand a little more. Um, we've seen platforms come and go that have tried to play in this space a bit, and other folks who, again, who have tried to dabble, come into the space a bit, get folks access to franchises, and it hasn't gone well. And by that I mean like the platform hasn't been able to make it work. And
Mhm.
the biggest challenge that I've seen is that it's one thing to source great deals. It's another to have enough dollar demand to go into those deals to interest those folks in wanting to work with you, right? Like best in class operators, there are private equity funds, and now all they do is invest in franchisees who are really good at what they do, who are time and time again really great operators. How are you winning these deals? And by the way, you've won a lot of deals. Like go to their site; they have amazing deals. So I think
Yeah.
you guys have like figured it out, and it's really cool to see. So I want to understand how you've done that and how you're managing both deal sourcing as well as being able to say we can deliver, because otherwise you won't be able to get into those deals.
Yeah, that's a great question. First and foremost, I'm from the franchise industry. Other people that have tried coming into the space, they usually are from another industry and trying to go tangential into franchising. It's like, hey, we want to raise fractionally for startups, but then, hey, here's a franchise too. And so they're not focused on franchising. They don't know how to talk to franchise people. They don't have the relationships there, and nor the investors that come from the space too. So let's just say I speak the language and I know the people from once upon a time because I've been in the industry a long time. But then also, people want to see that investors are aligned with how they're growing too. So, like what their goals are, what their timelines are, what their payback periods are like. And so we're, really coming at it from both the franchisee and the investor to try and find a true middle ground there. Because, like you said, private equity dollars are coming in fast and bountiful in the area. But I'm not sure you guys have worked with a ton of private equity people. A lot of brands do not like working with them.
Hmm.
A lot of times it comes with losing control and losing terms of the deal and not being able to say how you're going to run your business. And frankly, that's why these people get into franchising, is to be their own boss. Yes, they'd like to not develop a whole new brand, but at the end of the day, they're still their own boss. They own their own business. They are running employees. And so, yeah, being able to like come from the industry, work with them based on how they want. And also just, we've been able to like, we market directly for people who are interested in franchise investing. And so that's what brings investors that are going to actually fund these deals, is that's where their focus was. It wasn't I came for real estate and now you're showing me a franchise. It's
Right.
we're franchising and you found franchises. And I'll admit it's also a thing that comes with time. The franchise industry is a very slow moving industry at times, because they're big ships to correct. And so, getting started, it was really a three-step plan over the years. It was, starting off, I knew, hey, McDonald's and Dunkin', they're not going to come banging down our door. We have to rise and get to their door. Even though I come
Yep.
from the space, they still need you to prove it, to prove that it can be done across the spectrum. And so we started off working with smaller up and coming brands where we were actually the operator ourselves. Eventually, we partnered with other franchisees on the operational front, but basically, like that's where we were coming from. We're like, hey, here's these two brands. They've got a couple hundred locations, and we're going to find or be the operators for it. From there, we proved, hey, we can raise for these type of deals. And then it was smaller brands and very proven operators. Because again, the biggest risk operator wise that we ever took was the first offering. And that's where the husband wife team came from. And we honestly that portfolio is crushing it. But we can't manage everything. We're not a giant franchise operator that of that sorts. So then it was okay. We want to work with the great operators in these brands now, and so we basically started working with directly with the brands and directly with the operators to say, hey, we've proven this before. We'd like to do it for you now. And these are great opportunities to get into because you've got people who have done major brands. Like one of our offerings with Hawaiian Bros. That brand has about 300 or 400 that are open or in development, and they do Hawaiian plate lunches. And it is the fastest fast food you will ever see. The guys who created the brand, they're big Lean Six Sigma guys. And so I actually cold shopped them before we ever started working together. And it was 30 seconds from I place the order to I pick it up, and you could tell it's fresh. It was unbelievably fast, great value, great product. And so I like the brand a lot, but still, it's a newer brand. You got to have great operators. And the operators that we were working with, Choice Hotels, which has like Comfort Inn, Sleep Inn, Quality Inn, all those guys, they have like 2 dozen of these hotels. Scooters Coffee, who they're the second largest coffee franchise behind Dunkin'. They've got, I think, 2 dozen of those as well, and they were franchisee or franchise developer of the year twice, and they set the record for fastest store to 1 million, and then they beat that record by 60 days. Uh, Add in half a dozen Verizon stores. They were just like every brand and industry they went into proved that they could be great operators, and so it
Wow.
was like, yeah, no brainer. Like, gotta invest in these
Yeah.
guys. And then from there, again, you just keep proving it in the industry. And now we're working with one of the top 10 largest operators of all of franchise, and they've got 450 plus locations. So
That's wild.
yeah, it's
Well, a few cool
patience and
things on.
proof.
No. Look, and I think that's how all good things are built. A few things that are interesting there. First off, if you kept your eyes out, you could have invested in Hawaiian Bros, the business, as well, via Reg
Yeah.
CF a couple of years ago. Um, Another thing that I think is interesting once you take the time to dive in on your various offerings on the platform, you know, we talk about this constantly at Kingscrowd. Diversify, 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 right? Again, not advice or financial advice, just an opinion that it probably makes a lot of sense to diversify. Um, what's really cool is that if you look at these offerings, they are diversified offerings. It's not invest in this Pizza Hut location, invest in this Dunkin' location. It's 5 locations, 10 locations, 20 locations, um,
Mhm.
which again, just from a de-risking standpoint, once again gives you access to a diversified portfolio rather than making one investment. So I'm curious in terms of that diversification, if I look at your various offerings, some are 10, some are 20, some are 80, some are 5. Um, how does that get put together? Is the operator coming and saying, hey, we want to finance these 5 locations for a remodel? Or are they saying, hey, we have 20, and you say, hey, we think we can meet you with 5 locations in terms of capital? Like, how is that portfolio coming together?
You know, there's a lot of different ways that you can put it. Like basically, we say yes to all the above. Like we want different types of offerings, so you can build a diversified portfolio within your diversified asset class. Like
Yeah.
like Larry Fink, BlackRock CEO, said the 60/40 portfolio is dead, and now it's a 50/30/20, with 20% of that being private assets like alternatives. And I'd be greedy if I said, hey, we should be the whole 20%. But like you want to be a little slice within the slice. And it's like some people might have crypto or real estate. You're not all in on one property or one crypto type. Sorry, I'm not a crypto guy. But you're not all in on one. You need to diversify across multiple offerings. And so we want the same thing in franchising. So you can build a portfolio that's diversified across different brands, different industries, and different structures. So within some of our offerings, you can find things where it's like, hey, we're contributing 20 locations and we're going to build this up to 80. You can find ones where it's like you said, we're going to scrape and rebuild or remodel 5 locations. Hey, we're going to build 10 from scratch. So you can find different points in time of like where they're set up at and how they're going to grow it to diversify your franchise slice of the alternative private asset slice.
And one of the other things that I think is always important in due diligence, and I think you're probably capturing this anyway, but what is the intention of the founder, right? Sometimes they lead with a story and then you find out there's a wholly other story behind why they're actually raising the money. I need to get
Yeah,
this guy off my cap table. Things are volatile. Like I've seen far too many things over the years, right, to just take it at
I
face
believe it.
value.
Yeah,
and
I
and
believe it.
and so like I'm curious, like if a group that is operating at a super high level, and they're saying, hey, we want to redo 5, 10 of our locations, and I know one of them is for like remodeling some stores,
Mhm.
to give away equity, right? Equity in a way is expensive. Why are they going the equity route rather than raising debt? Is it just to manage your finances? I'm just curious, why
Yeah,
folks are still willing to sell equity.
great question. And there's a couple different answers because we work with different types of operators. To start with the example that you said, and those are with that like scrape and rebuild model. That's with a group that again they have 450 plus locations, and so it's like why would they do that? Well, same reason anyone raises from for equity. Um, it's an alternative to debt, but like normally they'd be raising from private equity. And it's more expensive than selling equity, selling to private equity. And so they're looking for an alternative to that. That's something they can keep doing again and again and again, so they can build this to 1,000 location thing. So they don't want to keep doing debt. And then you've got other ones where they say, hey, I want to cash flow locations faster, and building them all with equity is going to get there. Versus if I have debt service,
Mm,
it's going to take me a lot longer to pay back investors and reach profitability. But then you've got other ones where, frankly, none of this that we're talking about is even an option. Like that husband-wife team I mentioned, the banks are looking at them like they're buying a home. And they say, oh, so you want $1 million home? Are you worth $1 million? Is your income 200K? And none of these things are true for them, but they have all the experience. And
mm,
it's honestly just like if you were doing venture investing, you're looking at the founder's experience, background, and drive. But imagine, like we're venture backed too. And honestly, I'm not worth $1 million. But if they were to say, like, hey, you're not worth $1 million, we're not investing in you. It's like, well, I have the background that no one else has. Like, you can't find founders like that then. And so it's the
hmm
same thing there. But frankly, the risk is greatly reduced because they're not trying to prove out some big new business. They're trying
Right.
to just don't reinvent the wheel, just keep stamping out the same ones.
On your website, you have projected IRRs, preferred returns, and the target hold periods for how long,
Mhm.
you're going to be holding investments. A lot of them are in that 3 to 5 year range, which I think is attractive for folks who've played in the startup space for a while, right? It's more like 10 to 15 these days. And
Yeah.
then some are closer, like the Hawaiian Bros one is closer to 8 to 10 years. Um, so when we think about kind of projected IRRs, you're investing in equity. How are you modeling out those projected IRRs to come up with that? And does that assume that literally these guys, after 5 years or 8 to 10 years, are deciding to sell these businesses, or is there some sort of like share repurchase or refinancing that happens?
Yeah, great question. So typically the models are built, again, we don't want to reinvent the wheel, nor do we want to overpromise. So what we can do is we can actually look at history and we can say typical locations are performing at this level. And so look at the average. Frankly, you've got better operators, so you're going to get above average performance, but like you still want to look at the average and say, hey, would I be happy with the average? And so
Hmm.
you can build off, hey, here's what, especially with the top 10 franchisee, it's like, hey, they're like, we own 100 other locations. We know how these locations will do. And so
Right.
there you're able to model off previous performance with the same model, just in a different geography. And there's typically an exit factored in at the end. And exits, once you've built, coming from the franchise brokerage days, one of the first questions I'd always get is, do you have a resale? Because frankly, no one wants to build it. And so when you do have a franchise that is profitable, you will not have a hard time selling it.
Mm,
I would tell my clients back then, if it comes across my desk, you want to run, because frankly, if it's like any good business, someone wants to buy it from you. And
right.
so if it's either a friend, family member, customer, or another franchisee or private equity. Like those are the ones that buy franchises immediately. If it hits the resale site or a broker, all those people passed on it. It means something's
Mm.
wrong. And so we're able to factor in eventual exit because there's all these buyers out there for the locations down the road. Some offerings will instead they might have a repurchase option in there. And so it really depends, again, all sorts of different offerings with different types of structures, but yeah, there's different ways that you can do it, and it's just kind of a case by case basis, but we always try and find some form of exit at the end, so that investors can get like a higher return on their investment.
So ultimately, I mean, a lot of these franchisers, they are looking to exit to move on to the next thing, to build the next thing, to diversify out of having all of their eggs in just the Dunkin' basket or whatever it may be. It sounds like
Yep.
that
Yep.
makes a ton of sense. I know you have some more slides, so I want to make sure we get to that, and just want to reiterate: if you have questions, please drop them in the Q&A, and around the 45 mark, I'll be sure to start getting to some crowd questions.
All right, perfect. And you still see my screen okay?
I can. Yep.
Okay, cool. All right. So I want to talk about the investment cycle afterwards because it's honestly very related to what we were just talking about. But first step is we're doing due diligence and looking at the opportunities and the event actually like coming together with them. I like to say we're not private equity or investment bankers, so we're not telling them like, "Hey, here's how you're going to raise, take it or leave it." It's their deal and they get to come to terms. We tell them if they're actually something that investors would want because some people think they're smart and they're like, oh yeah, I'll give them 3%. It's like that sounds great for you. No one's going to invest in that. So, we're fighting for investors ahead of time too. After that partnership is put together, we're then working with investors to fill the raise that they're doing. Um, Next, actually, they're running the franchise, obviously. And then, depending on the offering, like some are income focused, some are more growth focused. So if they're income focused, they're paying quarterly dividends. And then if they're
Huh.
growth focused, it's just an eventual exit. And so, yeah, then the ongoing returns and exit
So
eventually.
is income focus going to be more existing locations that they're like redoing versus growth is more we're building brand new locations type of thing?
Yep, typically, but it can also be either or too. So sometimes they're going to be doing new locations and they're going to share in the income, but it's going to take longer to have that income start. So you got to wait 12 to 18 months for those quarterly dividends to start coming, but then they come regularly.
Got it. Makes a ton of sense. Awesome.
Yeah. Um, but yeah, and then those franchisees, they want their investors to be happy. They also, they eventually probably want to grow too and do future offerings as well. And so they want to make sure that investors know everything that's going on. So there's at least quarterly updates that are both financial performance, but also the non-financials too. Like, tell us about the catering you're doing in the community. Tell us about the partnerships you put together, the new hires. Like you're an owner, you want to understand and feel like an owner. So we make sure our operators give out updates like that too. There's also the quarterly, like I mentioned, quarterly distributions, financials. And then we like to keep our investors really educated. So, what's going on in the franchise industry? We're actually going to be having the International Franchise Association's CEO come on webinar of ours probably next month. And we want people to understand the industry and be really comfortable with what's going on. And again, because we don't want one investment from anyone here, we don't want one investment from you. I want 20 investments over 20 years. I want this to be a regular part of your portfolio because just like real estate, it's something that is everywhere in the country and provides income and should be a good part of it. Um, I've talked about some of these, but like, here's some examples of live deals that we have. Like now we're working with top brands in the country. With Pizza Hut, they're contributing 20 stores and expanding to 80 in the Northeast. Dunkin' entire, believe it or not, funny enough, I'm actually in New Orleans right now. I'm scouting out wedding locations actually, but we're going to be bringing Dunkin' to New Orleans and the rest of Louisiana and
Huh.
Missouri. So, and I'll tell you, Dunkin' was really doing a big push on their ice drinks. And one thing people in Louisiana love, it is iced coffee. So we're really excited for that one. And then Burger King, it's a smaller one. They're doing 5 locations of the scrape and rebuild one. And so, really proud that we've gotten to this point to work with like elite operators and elite brands. And yeah, it's really cool. And um, Yeah.
Couple questions, Kenny. First off, can you explain what target return versus 10% preferred is?
Yeah, absolutely. So, the target return is obviously what we're expecting their annual returns will be every year. The 10% preferred is what they're going to be at least, because basically, if performance is under what their expectations were, they are still required to pay a 10% return to the investors first before they can pay themselves. So it's really giving the benefit of the doubt to the investors before the operators. So they're really incentivized to go and push that performance higher so that they can get paid more too.
Interesting. What is the average deal size on your platform?
Right now it's about 5 million, I'd say.
5 million. Nice. That's
Yeah, it's
awesome.
got some larger ones, got some smaller ones, but yeah, 5 million I'd say is our sweet spot. Can build
And
a lot
minimum
with it.
investment size?
Right now it's 10,000, and it's just for accredited investors, but in the next month or so we'll be opening up more deals that are available to non-accredited investors, and the minimum is just $500. The idea is really
Nice.
to democratize this asset class because we're talking about bringing Dunkin to New Orleans, and what's great is that it's a big brand name that will carry and do great in the market, but what's going to be even better is when there's people who live in the market that are investing and being evangelists within the community for the Dunkin' brand. And so that's another reason people raise from us too, is that like they want that network effect of people who are local investing as well, who are going to be supporters of that business.
Yeah, that's so cool. Handful of questions that have started coming in here that I want to make sure we get to. Um, First off, has crowdfunding been used much to fund individuals to become single location franchisee operators, e.g., a community funding someone they know to open and run a popular food franchise in an available neighborhood space? If so, are there any organizations or platforms that help specifically with that kind of funding?
That is us. We've done it before and we'll be doing it again soon. As I mentioned, there's like, and honestly, this will probably be the majority of our deals in the future is the people who are the hands-on experienced operators that lack access to capital. A lot of them aren't going to go do 5, 10 locations. They're going to start with one, maybe two, and get it going. And also there's a lot, like I said, they franchise everything. And so a lot of them will not be just food. Good example is in the home services space. There's brands like Mr. Electric or Molly Maid or Mr. Rooter, where they don't have like, hey, here's my one physical store you got to come in and out of, but instead they own an entire city or region. And so we'll be working with like the operators that have come up through the ranks within these brands and industries and looking to go out on their own, but just never had the opportunity before to do so.
Love it. Another question that's coming is do you have any opportunities like a fund where you can invest across multiple locations? And I think the answer is a resounding yes, but I'll have you answer it.
It's a soon. Right now, it's build your own portfolio, and we'll be launching more of that fund approach in the next year or so. There's just a lot of regulatory stuff that comes in, especially when we're combining different offerings from different operators. Yeah.
Got it. But to be clear, most of your offerings do involve multiple locations at least,
Oh, yeah,
correct?
yeah, yeah. Oh, yeah. Yes, they do. So, like in that sense, yes. But I'm talking like multiple brands and
Yeah, you
industries and
got Pizza Hut and
geographies.
Dunkin' and yeah. No,
Yeah, I
that's
want to.
cool.
Yeah, I want to put all three of these into one offering, and you can get a
Yeah, I would
piece of
love
that.
that too.
Yeah,
Absolutely.
yeah. But
Um,
for now, it's but honestly, some people don't. They're like, hey, I'm a Domino's guy instead, and which
right.
I'd say that is the biggest trap in what we do is that people have allegiances, allies, and enemies in brands for whatever reason. But
Mm.
and they kind of go with the stigma of like, well, I like Domino's, so I'm a Domino's guy, or I like Starbucks. It's like, hey, just because you may like something or maybe not like care about a brand as much does not mean that brand doesn't make money. Like I live in Chicago and don't have a car. Like I walk everywhere. That doesn't mean I wouldn't invest in a Mako or Meineke to go because 'cause the performance is there. So you got to kind of take a step back and look at like this is one of the country's largest brands and you
Right.
got one of the best operators in the country. Like so that's the biggest trap there.
Well, I actually one thing I do want to hit on with that, it kind of like taking a step above, I think, where you guys come in. Um, like how does if you can tell us or if you know, like there's an operator, they want to open up 6 locations. That's great. And their experience, all that stuff. Are they going to Dunkin' and saying, hey, we want to open up 6 locations? Because Dunkin' has a strategy, right? Dunkin' needs to make money.
Yeah.
And ultimately, they're not going to let you just build them in middle of nowhere, wherever, right? Take your place like, hey, 7 people live there. We're
Well,
not going to let you build it there. So how does like the Dunkin' entity say, yeah, we want to open locations and then operator come together? How does that kind of dance happen?
yeah. So, well, first thing I should say, that's part of why you vet the brands because not all brands are created equal. Like someone said,
Mhm.
Subway earlier, and Subway is notorious for if you got the cash, we don't care. Like they'll let you open wherever you want because they just want to open as many locations as possible, and they don't care if some fail because they'll at least get the brand exposure that'll make other ones productive, which is terrible. And that's why you look at things like territory protections and stuff within those
Mm,
franchise disclosure documents. So you want to make sure that like a brand is at their advantage. And part of that you can see by the litigation section of a franchise disclosure document. Are franchisees suing the franchisor and what for? So you do have to be mindful of that. But then at any not even big brand, any franchise brand, they have established, hey, here's the territory size. It's going to make a location the most profitable without spreading it too thin and allowing others to open next to it. And so they said these are the territory sizes, these are the demographics that work for us. And they've got the whole country marked up. Every brand does.
mm.
And so when they're really just now looking for the operators to do it. And that's one thing that's really important about what we do is that like we're typically partnering on the franchisor level and saying who needs fund, like who should be funded. Who are these people that have the experience, have the will, you're gonna approve, and you want to be successful because they don't want to put their brand out in front of a lot of investors and it go belly up. So it's a lot that goes into it on the back end, but on the front end, it's they're looking for operators that know what they do. And but frankly, they already know who they are. They're people who either don't have access to capital or are looking for an alternative source of capital.
Makes a lot of sense. Another question that came through, can Canadians invest? And if so, can it be held within registered accounts, e.g. RRSP, TFSA?
First part of the question, yes, we love Canadians, and actually, one of our head of marketing is Canadian too. The second question, I will have to if you reach out to the ticket their support at franshares.com, we'll have to double check on that for you. I'm gonna say probably not for those specialty accounts, but we are open for Canadians.
Awesome. And then going off of that, how about IRAs? Can you invest out of retirement accounts?
Sure can. Yeah, we typically work with Alto IRA, and you're able to create and fund from there. And there's a few others that we can work with, but Alto is really the smoothest process there.
And that's pretty cool because I met if you're getting like, you know, 10 to 15% returns in these things fairly consistently, you're turning it over every 5 years. You do that for 20, 30 years on a non-tax basis. I mean, that's kind of a nice place to be.
Oh, I can make it a nicer place. Let's talk about additional tax benefits. You can actually, I'm not an accountant. This is not tax advice, but you can ride with the big, beautiful tax bill because you are investing into something that is actually creating a business and going towards equipment and real estate and stuff. You can write off up to 100% of your investment in the first year.
Oh, wow. That is very, very cool.
Yeah.
Another question asked, and okay, if you don't have an answer to it right now, I know you already mentioned it. Do you have a timeline when retail investors can start to participate?
About a month or two.
Non-accredited retail, month or two.
Yeah,
Okay,
yeah,
awesome.
yeah.
Excellent. And let's see, any other good questions here? I think that is the bulk of questions from the crowd. So yeah, if folks want to get started, franshares.com, create an account, start perusing the different offerings. I know you guys have a lot of educational content and have lots of information on each of the deals that they can dive into. And the beauty of this is I think most of us understand what these things are, right? It doesn't take a genius. Like, and if you haven't been to a Dunkin', go to one in your area. You haven't been to a Pizza Hut, order, Pizza Hut today, right? Give it a whirl if you want to like check in on it. Um, but that is very, very cool. Cool. Kenny, thank you so much for your time today. I sincerely appreciate it. Absolutely love what you're building. I think it's Such a cool thing and such a great
Thank you.
way to diversify your portfolio of private market investments. Anything else that you want the crowd to know before we wrap it up here?
Education, first and foremost. Like when you sign up, we have a franchise investing guide, and I read it, please. Go hop into webinars like this and other ones we've done in the past. Learn about it. Like, I don't think you should invest in anything blindly, and I think frankly, you'll invest more once you do get it. So I'm just very big on people understanding and educating themselves. So take the time, take a Saturday, go check everything out, and learn a lot.
Well, I know I already mentioned this to you. My goal and hope is in the coming month or two to get some of these operators of the Dunkins and the Burger Kings that you're investing in to have them on my podcast and dive in deeper with the operators that you're actually backing.
Love it.
Because again, just big fan of this, and I really do want to provide more exposure to our investor base. So, Kenny, thank you so very much for your time today. Thank you for what you're building. I know it has not been easy as anything in kind of the crowdfunding market, but this has certainly been a tough slog to get into these name brand investment opportunities for folks with some of the best operators. So thank you, thank you, thank you for what you're building for the industry. Definitely go check them out. Thank you everyone for tuning in today and stay tuned for future episodes of our educational webinars. Have a wonderful day, everyone, and thanks for attending.